Welcome to our lecture on personal finance, focusing on credit usage and loans, designed specifically for college students like you who are navigating early financial responsibilities. Credit is your ability to borrow money with the promise to repay it later, typically with interest added. It allows you to make purchases now, manage cash flow during tight months, and build a strong financial reputation over time. There are several key types of credit, including revolving credit like credit cards and lines of credit, which let you borrow repeatedly up to a set limit. Installment credit involves loans repaid in fixed payments over time, such as car loans or student loans. Open credit refers to accounts that must be paid in full each month, like utility bills. For example, paying off a $400 credit card balance each month on a $1,000 limit helps build good credit without incurring interest charges, as recommended by the Consumer Financial Protection Bureau. A credit report provides a summary of your entire credit history, while a credit score is a numerical representation, usually from 300 to 850, of your creditworthiness. Credit reports contain your identifying information like name, address, and social security number, plus credit accounts both open and closed, payment history, inquiries from lenders, and public records. Credit scores range from excellent, typically 750 to 850, good at 700 to 749, fair from 650 to 699, down to poor below 650, according to standard FICO models. For instance, a score of 720 might qualify you for a 5% auto loan rate, but dropping to 640 could raise it to 9%, costing hundreds more in interest annually. Maintaining good credit not only helps secure favorable loan terms, but also leads to lower insurance premiums and better financial opportunities overall. Paying bills on time is the largest factor in your credit score, often weighing 35%. Also, keep credit utilization below 30% of your available limits to stay healthy. Avoid opening too many new accounts at once, as it can signal risk, and regularly monitor your credit reports for errors using free services like annualcreditreport.com. For instance, on a $5,000 credit limit, keeping balances under $1,500 maintains a healthy utilization rate below 30%, which positively impacts your score. Loans can finance important goals like education, vehicles, and homes, but remember, they also create long-term financial obligations that require careful planning. Main types include student loans, either federal or private, auto loans secured by the vehicle itself, and unsecured personal loans often used for debt consolidation. Payday loans are short-term, high-interest options with predatory rates that trap borrowers in cycles of debt, so they should always be avoided. Borrowing $20,000 for a car at 6% interest over 5 years results in a monthly payment of about $387, with total interest paid around $3,200, as calculated by standard loan formulas. The true cost of credit depends on interest rates, the length of loan terms, and any additional fees that lenders might charge. Simple interest is straightforward, calculated as principal times annual rate times time in years, or I equals P times R times T. For example, a $5,000 loan at 10% annual interest for 2 years yields exactly $1,000 in interest using the simple interest formula. Federal laws are in place to protect consumers from unfair credit practices and ensure transparency in lending. Major laws include the Fair Credit Reporting Act, which ensures accuracy, fairness, and privacy in your credit reports. The Fair Credit Billing Act protects against billing errors by requiring prompt corrections, and the Equal Credit Opportunity Act prohibits discrimination in lending based on race, gender, or other factors. The Truth in Lending Act requires clear disclosure of loan terms and costs, while the Credit Card Act of 2009 restricts sudden rate hikes and protects cardholders. For instance, under the Card Act, credit card companies must give 45 days notice before increasing your APR, and you have the option to cancel the card. Poor credit use can quickly lead to excessive debt accumulation and long-term financial stress that affects your daily life and future plans. Warning signs include making only minimum credit card payments, borrowing new money to pay off existing debt, and frequently overdrafting your bank accounts. Effective strategies to manage debt include the avalanche method, prioritizing high-interest debt first to minimize total costs. Consider consolidation loans to secure lower interest rates on multiple debts, and seek free help from nonprofit credit counseling agencies like those from the NFCC. Responsible credit management enhances your financial flexibility for opportunities ahead, while poor habits can severely damage your long-term goals like homeownership. Key takeaways include always maintaining low balances relative to limits and making all payments on time to build strong credit. Always review your credit reports annually for free at annualcreditreport.com and understand your rights under key credit laws. Finally, borrow only for productive, manageable purposes that align with your goals to ensure informed and ethical borrowing decisions throughout your life. Thank you for watching this video on personal finance, credit usage, and loans. We hope this information helps you make smarter, informed decisions.